Alrighty, so now today we'll be looking at we'll be looking at how price actually behaves. I know in either part 1 or 3 of trading in line with the institutional order flow, I tried explaining using the daily time frame how price behaves. Let's see if we could do a quick recap before we proceed. Like let's use EU. Let's use EU for this analogy. Euro USD. Alrighty, right? I tried explaining here that price has a way it moves. And if we can understand that, there is every likelihood that we could maximize or use that opportunity to get some pips off the market. Now let's look at this downtrend. Let's take a look at this downtrend here, right? You'd notice that price was making a downtrend, a downward move. But would you notice, let's magnify this a little more so we could see even much better. Do you notice that price pushed down, went back up? This was the low of the day, pushed back somewhere, closed there, opened the next day here, and at one point in this day, it pushed into the close of this particular day. It pushed into it, and then dropped. Also created the low of the day and pushed back up to close. Opened the next day at that same price, and at some point on this third day, it pushed into the close of this day and dropped thereafter. Created a low, pushed back up to create a close. Opened at the same price the next day, pushed back up into the close of this day and dropped thereafter. You could notice that it happens frequently. I'm choosing the word frequently because it doesn't happen all of the time, but it does happen frequently. And what you need to make money from Forex is have a winning edge. Edge meaning that it happens frequently, right? So, and I mentioned in that webinar that if you could design a strategy around this, or let me put it this way, imagine if you were able to find a way of discovering that this was a downward trend, perhaps after price had broken through this point, you've been able to discover that this was a downward trend, and you waited on this particular day for price to break above the close, and then you set your sell stop for a sell. The next day, wait for price to close above the close of the previous day, set your sell stop for a drop. Wait for price again to close above the close of the next day, set your sell stop, drop, right? Notice how you would have made profits. Also on the way up, say you were able to establish that when price broke this above this point, you were in a buy scenario. Notice how price opened from this point, pushed up, created the high of the day, and then fell down a little and closed. And how price opened at the same price the next day, and at some point within this day, price dipped beneath the close of the previous day. Could that have given you an opportunity to buy? Notice how price also dipped beneath the close of the previous day. Could that have been an opportunity to buy? And you could see that happening over and over and over again, right? Food for thought. Move how price moves. We're trying to look at how price moves. Now I'm going to be explaining some terms here. Learned them from ICT. I'll be looking at gaps, right? So many people have several names they gave it. I'll be looking at it as gaps, right? And I'll try to explain what a gap is. Now let's go down to 15 minutes. to explain this even further. Go down to 15 minutes. And we're going to be using this range here. We're going to be using this point here to explain our point, right? So let's take that out. Notice that it seems like price always tested a particular, or a price action went above or beneath a particular point more than once. Now I'll explain that in a minute. Price pushed down. Remember that horizontal lines are your price. The vertical lines represent time. This is price. So take this candle here as our reference candle. We're taking this candle here, this bearish candle, as our reference candle. So I put an X there. This is our reference candle, right? And by reference candle, I mean forget about every other thing that has happened prior to this particular time. Take this as our reference candle. Sorry, somebody's mic is on. Kindly unmute, or rather mute out yourself. So let's take this as our reference candle. You'd notice that as price pushed down, price also came back up. From our reference candle to the next candle to the right, it seems like this particular price of 1.10021 was offered at least twice. It was offered on this candle once and also offered again on this candle, right? It was offered here, price went back again, and at that same price, it was offered again. Now let's take this candle now as our reference candle. Notice that this same line, price at that same price at 1.10021 was offered on this candle, and price came back again and was offered at that same price, right? Price action came back, it was offered at that same price. Second time. Now let's move this to this point. If I push this down here, you would notice that price was offered at this price at 1.009946 only once from our reference candle. It wasn't offered again, right? Price never came back to that point. It meant that price was not properly traded. And by so doing, you will notice that there's a gap between this wick here, these two, the wick above, the wick beneath this candle, and the wick above this candle. This is called a gap, right? Because price around this zone was only offered once, which is in this candle. Price was only offered once, which is within this candle. And we want price to be offered more than once at least. So when we see a gap like this in the market, we will be anticipating the possibility for price action to want to make its way back and close that gap. And by closing the gap, I mean that for a week to come back up to the high of this rectangle to close up the wick here, right? At that point, I say that the gap has been closed. I give us an example. So notice that the wick here, the down wick of this candle and the up wick of this candle has an intersect. That was why price was offered more than once, right? Same thing for this. The down wick and the up wick seem to have an intersect somewhere, right? So price was offered. At this particular point, the down wick and the up wick seem to have some form of intersect, but the down wick of the candle prior to the reference candle and the down wick of the candle after the reference candle did not have an intersect. And that is the secret behind spotting a gap. You want the wick of the candle, the wick or the body of the candle before your reference candle, and the wick or the body of the candle after your reference candle to have some form of intersect. So let's come here and see an example. Let's see one example here. So take this as your reference candle. Take the bullish candle here as your reference candle. This is the candle before your reference candle, and this is the candle after your reference candle. There is no intersect at all between the wick or the body of the candle prior to the reference candle and the candle after the reference candle. So the distance between the up wick and the low wick of the candles before and after your reference candle gives you your gap, right? Some people call it a void, because price at this point was offered only once, and that is on the reference candle. If you are in a buy in this scenario, you should expect that there's every likelihood for price to want to come back and close that void. That is the nature of price. It always tries to close a void. It always tries to offer a particular price at least once or twice. Now, so price pierced above. Say I was going for a buy and I see this pullback. I shouldn't chicken out and get out of my trade. Most times as retail traders, when we jump out, we miss the big move. We miss this big move that would have happened simply because we jumped out, right? I should expect that there will be a pullback. If I entered at the top of this candle, if I enter at the top of my bullish candle, I should expect that if the nature of price is to remain the same, there might be a pullback to cover up this gap. Price never really covered up the gap here, but you notice it made an attempt and then pushed back up. Now, what does this knowledge do? It helps you hold on to your trade when you seem to have something that looks like a pullback, right? If price breaks this point and goes down, then I'm seeing a situation where it might just be a losing trade and I could jump out. But for this pullback, I should expect it to make a pullback. Let's come to this other point. Say this bearish candle was my reference candle, right? So that's my reference candle. This is the wick, the up wick of the candle before my reference candle, and the down wick of the candle after my reference candle. This has no gap because there's a clear intersect between the A candle, that's the candle before my reference candle, and the B candle, the candle after my reference candle. There's a clear intersect. You could see by the horizontal line there that price was offered 3 times in between these 3 candles. Price was offered, the same price was offered 3 times between these 3 candles. So there's no gap here, right? Now let's come back to this. Say, take this as my reference candle, this bearish candle. This is my A candle, the candle before the reference candle, and this is my B candle, the candle after my reference candle. Notice how the down wick and the up wick made some form of intersect. Meaning that if I move my horizontal line here, price was offered 3 times, right? Price was offered 3 times. Perfect. I want that, right? And why are we studying this? It's so we could stay in our trade and not jump out too early. Let's take this point as our reference candle. Say point X is our reference candle, the bearish candle. And we got into a sell somewhere around here. Say we got into a sell somewhere around here. Just for the sake of illustration. You would notice that there's clearly a gap here, right? There's a gap between the down wick and the up wick of the A and the B candle. A and B candle. So when I sold and I was in profit and I noticed a push, I shouldn't jump out of this trade because I'll be anticipating that price may come to close this void or gap before resuming its downward move. I should be anticipating that. I shouldn't jump out of this trade simply because I noticed a pullback and then miss the whole of the move that I would have gained if I understood how price moved. Take this bearish candle as my reference candle. Notice that the down wick and the up wick didn't have a perfect intersect. Can you notice the small gap between the A and the B candle? You notice a small gap between the A and the B candle, right? So say I was going for a sell, I should expect that price will push up to cover that gap, right? And price did that. I might be thinking of getting out of this trade if price continues to pierce into the body of this candle or even above it. Then I might be thinking of getting out of that trade, right? Let's take this one as an example. Let's take this bullish candle as our reference candle. So the candle to the left becomes our A candle, and the candle to the right becomes our B candle. Notice that there is no intersect between the up wick of the A candle and the down wick of the B candle. Can you notice that gap? Let's mark it up here. You'll notice a clean gap, even though it's small, but there's a gap there. You notice that gap? Yes, it's there. You see that? No intersect, meaning that price within this rectangle was offered only once, and that was in the reference candle. I should expect that sometime in the near future, price will want to come back, to that point to close that gap. And if price do that, oh yes, price came back. And once it closed the gap, pushed up. If I'd run out of this trade simply because I saw this pullback, I would have missed all of this move. I should be able to understand this. Now let's take this red candle as my reference candle. The red candle is my reference candle. Notice that, okay, let's take the bullish candle. Let's take the bullish candle as our reference candle. Notice that the up wick and the down wick of the A and B didn't quite have an intersect. So what do we have? We have a small gap, right, between this and this. Price was only offered once on this candle. I should expect, as a trader, I shouldn't expect that because I've entered for a buy, then the whole world should continue to buy and price should never retrace. That would be tantamount to being naive, right? I should expect price to pull back and cover this gap. And that was exactly what price did. It came back, almost covered it. Maybe for some brokers, it could have covered, maybe, and then pushed back up If I'd run out of this trade simply because of this pullback, then I could have missed the whole of this move. You're looking at the mechanism of how price moves. On any time frame, my brother, on any time frame, do this on any time frame. What it does is that it just helps you understand how price moves. Now, the movement up and down are smoother on the lower time frames. They are smoother on the lower time frame, right? If we go to the higher time frame, it's a different kettle of fish. There are some similarities, but we use those points as our target points. Price will always cover up a gap. Now, let's come here. Let me show you what I mean. Notice how there was a gap between this point and this. Notice there was a gap between this point and this. So if I have a strategy that tells me to buy from point X here, my take profits should be any gap price made on its way down. Notice that price will always seek to cover any gap between A and B candle. I'll repeat this webinar again, maybe in a more concise manner. But for now, let's play dirty with it. The candle before my reference candle is A. The candle after my reference candle is B. I noticed a gap and price never came back to close that gap. It fell and continued its move, right? It created another gap right here. You notice how easily I seem to be able to spot it. With time, you do likewise, right? And price came back and covered this gap. So this gap is no longer in existence because these two bullish candles have come back to cover this gap. So this is no longer in existence. But this gap here was never covered. So when price is making a pullback and I have a strategy that helps me take a trade for a buy, one of my target points should be this gap here. And you'll notice how price came to fill that gap. This could be my target point. And after filling it, did some things, it dropped. Right? Price will always seek these gaps to fill. Notice how price came back, filled it, and dropped. Price didn't create any other gap on its way up. Price loves to be properly and fully traded. Let's go to the higher time frame since someone asked and see. 1 hour. Remove all drawings. So you notice here clearly that there is a gap, right? I believe you all can spot the gaps now. I'm taking this point here, the bullish candle, as my reference candle. You can easily spot the gap between the up wick and the down wick. Price never traded, was not offered more than once on this time frame. Should I have a strategy that helps me to sell? This point here will be one of my take profits. Right? I expect price to come, fill up that gap. And price did. Right? Do I have another gap somewhere? Oh yes, I can see a gap here. Right. I'm waiting for a push up. Perhaps price will come to take out that point. Right? So even though the aim of this webinar, at least for this point, is not take profit or stop loss, it's more or less like helping us hold on to a winning trade. The challenge most times is that we're in a hurry to run out of a winning trade and we don't get that move. Let's see a good example of how we could have run out of a winning trade and then bite our fingers. Oh, sorry, coronavirus doesn't allow anybody to bite fingers now. Okay, so let's see this. Let's take this point as our reference. Let's say for any, okay, let's start with this. The bearish candle happens to be our reference candle. We saw this engulfing candle, and after the engulfing candle, price closed, and we pulled our trigger for a sell upon the close of that candle. So let's delineate this as a blue candle, right? So we got in on the blue candle, on the blue line rather. After this engulfing candle, we got in for a sell, and we were in profit for a while. Notice that when we got in, price created a gap here. Do you notice that gap? Sure we do. It's only normal for me to anticipate that price will do a pullback to take out this gap. Do I need to wait for the gap to be taken out before going in? No, because sometimes price may never come back to take out this gap instantly. It could do that a week later, few days later, few hours later, right? So if my strategy tells me to fire for a sell at this point, I should go in for a sell. But I shouldn't be scared when I see 3, 4 candles in the opposite direction. I should expect that gap should be filled. Price came, filled the gap, pierced up a little, and then dropped. Clean. It never created any other gap on its way down. Now, at this point, price gave me another gap between this point and this. Let's give that a different color. Right? Price gave me another gap. I should expect, if I'm not out of this trade already, if I'm not out, depending on your trading strategy, if I'm not out of this trade already, I should expect a pullback for price to close that gap. And price came, closed the gap, and then did what? Dropped. Clean. On its way down, again, price created another gap somewhere here. Let's give that yet another color. I should expect that price should push back up to at least close that gap and then drop. Notice my choice of what I should expect it. Doesn't mean it has to happen every time, right? But in Forex, nothing is sure, right? There could be volatile conditions and price just keeps moving and moving and moving. But this is how price usually behaves. Notice how price came back, filled up that space, dipped up a little, and then dropped. Imagine if you had run out of this trade, say you were in, let's see, say you were in 76 pips profit, and price began to push back up, you got so scared, and you ran out at 10 pips profit. And shortly after you did that, price dropped and continued its move down. Very painful. Notice another gap between this candle and this A and B candle. Notice how price retraced, covered that gap, played around a little, and dropped. So once you've been able to use the institutional order flow to determine price direction, you should be patient enough for price to do its thing. Let's get out of that childish thought that because you and I have pressed a buy or sell on MT4, then the whole world should move in our direction. We need to understand how price itself behaves, and that will give us a winning edge, right? See another gap right here, gap here. Price filled it up, right? Notice sometimes you will have several gaps, like in this point, I have this as a gap. Oh, I have this as a gap. And oh, I have this as a gap, right? If for any reason I have a strategy that tells me we are now in an upward trend, each of these points will be a point for take profits, right? Someone asked a question. Well, somebody said, what if someone places an order on all the gap, like a limit or stop order following the ICT? Well, you could do that, but remember, you should have a trading plan, a trade plan, and you should have a strategy you stick by. If you trade more than 2-3 strategies and you don't have a journal, you most likely blow an account. Most likely blow an account, right? So it's better you have a strategy. What we're looking at now is the order flow strategy. We're looking at the order flow. So we have our order flow already. Say our order flow is bullish. Let's go to the 4 hours and we must round this up now so that it doesn't get too long for YouTube. So let's say we've gotten a bullish order flow. If you understand what I just explained in terms of gaps, you would understand why sometimes we don't take the sell, we just wait for the push up, right? So you have you have a bullish order flow and you have price coming against you. You shouldn't be scared. You should know that price will do some pullback. See this point here. This is a gap between this and this, right? Say you enter the trade from this point, and for one reason or the other, you've been able to pick out your TP 200 pips away. You shouldn't be scared of this 1, 2, 3, 4, 5. That's 20 hours of pullback, right? Because you expect that this gap should be filled on a normal day. Price did fill, and in just 4 hours, it eclipsed all the movements of 20 hours, right? So you shouldn't be scared when you see a pullback. You should know when to expect one, especially when there are gaps in the market, right? So that about sums it up for